As we open up a new month, it's time to take stock and look back at September to gauge exactly what the big trends are within financial markets at the moment. Taking a look at the indices, the FX, and the commodities space, I'm going to show you exactly what the biggest movers were in both the upside and to the downside, and try to understand exactly whether these trends are set to continue as we move forward, or whether that recent move has been overshot somewhat and due a reversal. So here's the breakdown for the indices space, and the big outlier here is the Hang Seng. Chinese stocks really caught a bid, to say the least. Most of it really happened at the back end of the month with the announcement from the PBOC that they were cutting some of their key interest rates. They were also trying to enact new measures for home buyers. They were allowing people to renew their mortgages at more preferential rates. We saw the announcement that they were talking about the possibility of funding to help bolster the equity market. So a whole raft of measures. Now, this isn't the first time that we've heard from the PBOC to provide stimulus, but this is the first time that we've seen stimulus on such a scale. The sheer amount of announcements all taking place over the course of a handful of days really provides the basis for people to think this is the beginning of the end, and that it's time to jump into Chinese equities. That's exactly why we've seen such strength for the Hang Seng. On the flip side, we've seen another Asian market, the Nikkei 225, really underperforming. And that comes as we see strength for the Japanese yen. Of course, whilst we saw the deterioration of the yen, we saw Japanese equities outperform on the fact that they become competitive on an international marketplace. And they, of course, are able to sell more products. At the same time, businesses that are reliant on tourism suddenly get a massive influx of tourists because it's so cheap to visit Japan relative to how it has been in the past. Well, that started to change recently, and we're talking about this carry trade for the dollar yen starting to unwind. And as we see dollar yen rolling over, so we've seen some question marks really asked around those valuations for the Japanese equities as we see the strengthening Japanese yen. Now, at the back end of the month, we also heard about a surprise winner for the leadership bid of the ruling party. So the new prime minister is now someone that is going to likely be supportive of further rate hikes and the further tapering of JGB purchases. That, again, isn't necessarily great for equity markets, and markets have been hoping for a new PM that was actually more on the dovish side of things. And that's why we've seen some weakness in terms of Japanese stocks. Let's jump into the charts for both of these and look at exactly how they're shaping up. First and foremost, I wanted to bring up the Hang Seng. Here it is in all its glory. Now, we can see here, in terms of the monthly time frame, this is an incredible month. The last time we saw something like it was back here in November 2022. Now, we can see from a wider perspective that this index certainly has been floundering for some time now. You can see these peaks that we saw in 2018, 2017, and then 2021. And then we've been selling off dramatically since. I mean, if you compare that to, say, the S&P 500, you can see that massive divergence in play, right? And that isn't always the case. You can see periods of time where they sort of track quite well together. But then, over recent years in particular, as we saw the sort of zero COVID policies really hurting consumption in China, and then more recently, we've seen this particular weakness in the manufacturing sector. We've seen deflation in China, and we've seen US equities really outperforming. What does this mean? Well, it means that if you've been trading over the course of recent years or investing, by and large, you're going to be looking towards US stocks as the safest place to be on the long side, right? If you're buying stocks and you're buying it in China down here, you're probably going to be looking at what's happening in terms of US equity markets and wishing you hadn't bought Chinese, wishing you had bought the US stocks. But this could start to change here. And certainly the announcement we've seen in terms of the stimulus measures does provide the basis for a shift. The initial shift comes in sentiment. So that's what we've seen here, right? We haven't seen any major uptick in terms of the economic data. We've seen a little bit of a better manufacturing PMI, but we saw weakness in the services PMI. We saw weakness in the Kaishin manufacturing PMI. So it's not like we've turned a corner in terms of the Chinese economy. And certainly a lot of that's going to come down to the housing market. We need real estate to really start to improve, because there's so much money that's sunk in the real estate market. As long as that's deteriorating, there's really very little cause for optimism. Nonetheless, they're taking measures that should prop up the housing market. They're taking measures that should bolster spending and lending in the country. And so all of a sudden you start to look at Chinese markets and say they're massively undervalued if they can piece all of this together. And that's why we've seen such an incredible rise over a short space of time. You can see that much of this rise happened in the final sort of third of the month. Really dramatic surge that we've been seeing. The caveat here is, of course, when you see such a sharp rise, at some point you're going to get a pullback, and that pullback is likely to be relatively sharp in nature. If you compare the size of the pullback when it does happen to the kind of pullbacks that you're seeing in the past, it's likely to be significantly higher. And that's because, of course, you've got a much bigger move that is being retraced. So where we are at the moment is that we've got the announcements that provide the basis for greater optimism. That optimism has transferred into this massive rally. I have no doubt that this is likely very oversold when it comes to, say, momentum indicators. Let's get the stochastic. So very oversold. I mean, look, we're already oversold before we even got into that major rally. But you can see here in terms of the stochastics on a daily time frame, this could be a particularly useful metric to be using or indicator. So we're sort of chopping around that overbought territory. Sorry, was I saying oversold? I meant overbought. So we're chopping around that overbought territory. You can see something akin to that here. And typically the way that I like to utilize stochastics, number one, I like to use it in a manner that is consistent with a market that has worked well in the past. And therefore, if you're looking at this does not work well, right? So you're not going to be looking to buy or sell on any of those signals. If we're looking at the moves that we've seen previously on the top end, you can see that, we sort of chopped around here for a long time as the market's rising. So that shows you why you don't just sell a market that's just broken into overbought, because it can stay overbought for a long period of time. But once we see the break back down through that 80 threshold, then that actually marked the top for this market. So that was a pretty good sell signal. Now, the caveat here is, of course, we're winning a bearish trending market. And now if we do turn towards the upside and this marks the beginning of the bull phase, then that could switch. But nonetheless, you can see here, once we saw that breakdown through the 80 threshold, that's when we started to see the pullback. We could see a similar kind of thing here. Basically, as long as the stochastic remains above the 80 threshold, then maybe we see further upside. But a breakback below that level could point towards waning momentum. We start to come into a retracement phase. But this is the beginning of a potential wider move, as long as we can see the other steps being pieced together. The first step is the announcement. The second step is sentiment. And the third step is data. And the data needs to start. We need to start seeing the leading data in terms of consumption, in terms of lending, in terms of the real estate sector. If we start to see that pick up, that's where we can see a continuation of this trend. And until that happens, certainly you could see another gap higher and another gap higher. We don't know how far this goes, but at some point we're likely to see this unwind to an extent until we get confirmation that, this initial announcement is actually going to have a significant impact on the economy itself. In terms of Nikkei 225, I think this is a really interesting one. So look at this correlation between the Nikkei 225 and dollar yen, right? So sometimes you see it really closely correlated. Sometimes you see inverse correlations. So it sort of switches between negatively correlated, negatively, positively, right? Positively down here, then we're seeing divergence, so negatively correlated. So it's really interesting these periods of time. And you can see here as I zoom in, it's back to being positively correlated at the moment. So when we do see these strong moves higher, or appreciation of the Japanese yen, that generally does provide the basis for people to think, oh, this carry trade could start to unwind once again, and we can see equity markets really weakening, and also people questioning the strength of these Japanese equities if we do see a really strong rally for the Japanese yen. Nonetheless, let me just get rid of that, and let's look at it in its entirety, right? The trend is very much a bullish one, but of course we've also been traded within a bullish dollar yen environment. But so if we do see dollar yen rolling over, and as we can see here, it's come back down into that prior low. If we do see a breakdown through that low and we top out in dollar yen, that provides the basis for underperformance for Japanese stocks in particular. The daily time frame shows you that we've seen quite a lot of chop at the moment. We've seen that sharp decline. The rally, that looked like a retracement, but then when we roll over, we only post a higher low, then we rally into a higher high. I would say this is a bit of a messy market, quite frankly. We're moving in this sort of downward stage at the moment off the back of this recent lower low, and it was a bearish engulfing candlestick formation on the daily time frame. That provides the basis for potential further downside in my mind. So you can see here, higher high, higher low, all the way up to here. Then when we break through that swing low, that points towards, for me, the next rally being a potential retracement before we roll over once again. That's exactly how it looks at the moment. Let me just get this into shallow retracements. Oh, it's somewhere in the middle. So we're in retracement mode and we're starting to roll over. 50% retracement to 61.8, starting to roll over. I think there's a good chance that we do see some further downside, but a lot of this will come down to sentiment and the movements that we've seen for dollar yen. If we see dollar yen break that key support level, it points towards the Nikkei 225 coming under pressure once again. So certainly, for a market that has been a big outperformer and a relatively consistent performer, that has changed, and we've now moved into a period of time where it's not as reliable. Quite frankly, you're going to see massive chop, and that's evident here on the monthly time frame. Look at these candles, right? There's so much indecision within this market. Small bodies, long wicks, that just screams of indecision, and that's not what we've seen in the past. In the past, we've sort of known where we're going. This is different. And a lot of that comes down to the trajectory of the Japanese yen. So this is a correlated market that you're really going to have to keep an eye out for. If you want to trade the Nikkei, you've got to also have a view when it comes to the likes of the Japanese yen. Let's jump back into it. This is the outlook for the FX markets. The outperformance came from the Australian dollar, managing to beat the Japanese yen this time around. And the underperformer comes in the form of the US dollar. Now, on the top end, the Aussie dollar. The Australians didn't necessarily hike rates to the extent of many of the other central banks. And so we didn't see them go above 5%, for example, like they did in New Zealand. The argument from the RBA was that much of the energy and efforts towards driving disinflation essentially going to be borne by the Federal Reserve. The Federal Reserve are going to hike rates by such a degree. We'll sort of hang on the coattails of that and hope to get some disinflation from that as well. Well, that didn't really work to a great extent because inflation in Australia is above many of its peers. And so we're sort of looking towards the Australians to think that they're going to hold on to their monetary policy for a more prolonged period. Currently, markets pricing in a potential rate cut in December. Now, should that come to fruition, then we start to see, relative rates. They didn't hike by as much, and therefore, they're going to kind of come in line. But we've also got this potential appreciation for commodity prices. And of course, this economy is so heavily reliant on commodity exports, so heavily reliant on demand from China, that this stimulus package from China does provide the basis for potential outperformance for the Australian economy, especially if we see strengthening in terms of the value of the assets that they will be exporting. Of course, that also raises demand for the Australian dollar, given that people are buying their products. So the Australian dollar also stands to benefit from the potential resurgence of the Chinese economy. And that, in part, is why we're seeing the strength of the Aussie dollar. Now, on the flip side, the US dollar, we've seen weakness in terms of the US economy. We haven't seen enough to say that we're going to see a recession, in my mind. Maybe an industrial recession, but the services sector remains strong. And the jobs market, whilst we have seen weakness, we haven't seen that explosive move higher in terms of the unemployment rate. We're going to continue to follow that. But essentially from here on in, I think it's a 25 basis point cut at each meeting. We could see another 50 basis point cut at this coming meeting, but that is slightly starting to be priced out by markets. But nonetheless, we're looking at an economy that points towards relative calm and easing interest rates, right? So you could say we're seeing interest rates being cut elsewhere. Why would it be the US dollar that's being hit so hard? Well, bear in mind that there's an expectation that if we see a soft landing and if we see interest rates being cut together, that provides the basis for outperformance for equity markets. A risk on environment, rates being cut, pro growth. We're not necessarily seeing a hard landing. We see a soft landing. Everything's perfect. Great. Well, that might take a bit of time to shake out. And certainly we could see some volatility because we've got earnings season coming up in October. November, of course, we've got the US election. But certainly if you look from a historical perspective, November typically marks the beginning. This is post-election in election years. November, we see that bull market really kicking off in a dramatic fashion. That does not benefit havens like the US dollar. And certainly when we're looking at the alternatives for sort of haven assets, the likes of the Swissy, the likes of the Japanese yen, both of them at periods where they're either close to ending their easing process or in a tightening process. And therefore, it's the outlier is the US dollar, where we see that big tightening process that's only just kicked off. We're going to see years of interest rate cuts and likely going to see strength for equities. And that provides the basis for weakness in terms of the US dollar. So if we were to jump on to the Aussie dollar against the US dollar, let's see the strongest against the weakest. Exactly how is this going to play out? You can see that that rally that we have seen over the course of the past month piggybacks off the prior month. So particular strength over the course of those 2 months. But you can see what you're trading against here is a long-term downtrend. So are we going to reverse that? Well, we've seen a lot of jitters, certainly over recent years, and those jitters translate into pessimism around the Australian economy and China, and optimism for the US dollar because it's haven role essentially, and as they're tightening interest rates. So there is a possibility of a breakout towards the upside. Now we have tentatively broken up through your near-term resistance level, which comes in the format of 68.71. So with the fact that we've broken through that, we want to see a sort of push higher from here to sort of leave this trendline resistance alone. You can see over sort of recent times, sort of last year and this year, we've seen this sort of what looks like an inverse head and shoulders basing pattern essentially. So that forms the basis for a potential exit from this and a push higher. We're selling off at the moment. Are we going to retrace into here and push higher? Are we going to just retrace into here and push higher? Or are we going to reverse the entire thing? Well, I don't necessarily see the basis for us to reverse the entire thing. I do think we're going to see US dollar weakness. I do think we're going to see Australian dollar strength, especially if we see that Chinese recovery coming into play and we see the outlook for growth elsewhere around the world picking up as we see interest rates being cut. And so I expect to see further upside for the Aussie against the US dollar, but you know, price action is key. So what we're seeing at the moment is this clear trend of higher highs, higher lows. This is on an intraday basis. 6817 is your near-term swing low. If we break through that level, it points towards a wider pullback coming into play for this pair. Until that happens, the near-term weakness that we're seeing at the moment could be another retracement before we push higher once again. From a fib perspective, we'd be looking out for, let's just put that into a deep retracement. You'll be looking for this area 6847, 6865. Those are your near-term sort of deep fib retracement levels. But certainly, you know, we have got a long-term downtrend in play. We've got this descending trend line in play. So there's a lot telling us we could top out here. But certainly if we push upwards from here, that could really build on the idea that we're going to see a protracted move higher as people become optimistic around stocks and optimistic around the idea that the Chinese economy is on the cusp of turning a corner. I wouldn't say that I wouldn't say has turned a corner because we haven't actually seen any data to signal as such. But the stimulus measures do point towards the Chinese government and the PBOC that is, you know, meaningful with what they're actually doing at the moment and actually going to follow through and try and save the economy after some difficult times of late. Finally, the commodities section. Once again, this is heavily skewed by nat gas, and I don't necessarily only want to be talking about nat gas each time because we just see, because it's been devalued to such an extent, you see these absolutely huge percentage moves on a month by month basis. So I'm going to look at platinum because I think there's a really interesting story about platinum and palladium at a time where, of course, we've seen big outperformance for precious metals like gold and silver. But all of a sudden, you start seeing significant signals of strength for some unloved markets like platinum, like palladium. Both of them done really well in September. And on the bottom end of things, you can see energy markets really taking a hit. So let's look first at platinum. Now, this is a really interesting chart because if I just show you this chart, I've got platinum, which is the candlesticks. I've also got gold, which is I don't even know how to explain that color. We've got a purple, which is silver, and gold, which is, I don't know, pinky. Gold, which is the bottom one. Yeah, reddy, pinky, something like that. So what's interesting about this, right? First and foremost, let's get rid of gold, the weird color, and look at silver against platinum, right? They have a really close correlation. You can see by and large, they sort of travel together. But then that's changed recent. 2024, you've seen silver taking off. So let's just see year to date. Silver's up. Tell you what, let me move to scale A. Change that to percent. There we go. Silver's up 31%. Platinum's up 4.5%. And that's off the back of a strong period, right? I mean, that's going to be even less if you're looking at the beginning of September. So platinum was pretty much flat on the year and silver was up 20 odd percent. Silver's now up 31% and platinum's up 4.5%. So there is a potential catch-up play in play here. You zoom in and you can see that we are seeing over the near term very close correlation between the two. So all of a sudden you're saying, well, okay, we've had periods where they don't trade together. We've had periods where gold does well, but platinum doesn't. You can see the long-term trajectory, platinum sort of sideways, gold sideways sometimes, but then having these breakout periods and then following it up from there. So undoubtedly gold is the leader in all of this. Silver follows on from gold, and we've seen that there are catch-up play recently with silver, but we see these sort of swings in either side of gold. So that's the sort of volatile younger brother. And platinum is sort of like sometimes jumping on the bandwagon, sometimes not. But more recently, where, you know, as we see strength in terms of the likes of gold and silver, we have seen this recovery play start to show out here for platinum. So what have we seen? We've seen this big bottoming area here in 2022 and 2023. We saw that surge from here. So we saw the rally, the pullback, the rally, the pullback. We're now in the next rally stage. I wouldn't be surprised to see this rally taking us up towards this area that we have here. Let me get rid of silver and then, yep, and then we're on to regular prices. Right, so we're essentially, in my mind, likely to be in the next phase before long to take us back into this area here, right? And the daily time frame shows you exactly that, right? So we've got this basing pattern, higher highs and higher lows. We start to sort of start small, we get bigger, right? And then we start pulling back, lower highs, lower lows, lower highs, lower lows. What have we seen now? We've seen a break through that swing high. We pulled back into a higher low and rallied up once again. So now we're into higher highs and higher lows. And so, you know, we've seen previously the sort of small moves and the big moves. Well, we're seeing kind of small moves at the moment, but I wouldn't be surprised to see a big move take shape before too long. So keep an eye out for this market. The near-term chart does highlight a very clear-cut uptrend that appears to be in play on an intraday basis. You can see here, if we're looking at sort of retracements, we came into a nice deep retracement here and now starting to push higher once again. So a breakdown through 954 points towards this market rolling over. But until that happens, I think there's a good chance we're in a sort of recovery play here for platinum. And this market that often gets ignored as people really focus on the likes of gold and silver in particular. If we see strength in terms of the precious metals markets, platinum could do well from it. And then Brent Crude. Now, Brent Crude is, you know, this is a really interesting one at the moment, quite frankly. Look at everything that's happening in the Middle East at the moment, you know, with Israel and Lebanon and Iran. Yet we've got massive downside of late for energy markets, right? So it sort of feels like people are just willing to overlook everything that's happening over there at the time. And you could say, well, look, there's been very little impact in terms of supply. And so that's a reason for us to essentially cast it aside. However, there's a wider story as well, and that is around demand and supply. Supply in the US remains high, but we haven't seen it continue to push higher, higher, higher. We've seen it sort of flat of late. We've got the potential for a rise in terms of OPEC production, and that could keep a lid on prices. And certainly we'll be looking out for commentary around that. But at the same time, we're moving out of a period where central banks are looking to drive down or depress economic activity in a bid to weaken inflation. And we're moving towards a pro-growth period, both for the globe, but also for China, because we've seen all these stimulus measures coming out. So there is the basis for the demand picture to really pick up in a meaningful manner. And you can see we've seen some volatility, but now we're starting to shoot higher, partially off of this talk about Iran potentially striking Israel. And of course, that raises question marks about a potential wider conflict in the Middle East. But also, we've got that sort of Chinese story playing into things. For the near term, we've got 75.87, which is your near-term swing high, alongside that descending trend line. And so, you know, that's a key area to be looking out for at the moment. But if we break up through this zone, could form the basis for a potential bottom. And certainly considering this latest pullback's come into this $70 low that we have from 2023, and everything that's happening at the moment in terms of the Middle East, in terms of the China story, in terms of the sort of pro-growth actions from the central banks, I wouldn't be surprised to see oil bottoming out here, quite frankly. And I'd need to see a break back below that $70 threshold for me to continue to be bearish after a period where, you know, being bearish oil was pretty easy over this period, right? Because it just every week it was falling. But things appear to be different now. We're in the third week out of 4 where, you know, we're seeing strength. And, you know, much of the weakness that we've seen in September was just born out of that first week, that big sharp decline. And now we've sort of kicked off a new month on a stronger footing. So maybe we start to see the tide turn when it comes to oil. But certainly this is going to be one of the more interesting markets for me, because we've kind of grown accustomed to weakness in the oil market. That, of course, has implications in terms of inflation expectations. But there are a lot of things that really highlight the possibility that we do start to see a more positive outlook take shape for the likes of WTI and the likes of Brent Crude, as we can see here. I hope that's been useful. Plenty of things to get through here. I'll be continuing to cover lots of different things as we go forward. We're also going to be providing live videos from the FX Expo out in Dubai next week. So make sure to tune into the YouTube channel to see all of that. We're going to be talking about oil. We're talking about gas. We're talking about loads of things. And so we can get into it in more detail there. Have a great day, everyone. Enjoy what will be hopefully an interesting month that is October. And certainly with the fact that we're seeing earnings season coming up, I wouldn't be surprised to see people get the jitters once again as they start to question valuations for big tech once again. That's certainly something that we've seen over the past couple of quarters.